Now, one question I often get is, how do I get into real estate investing without any credit? Maybe I have a little cash, I'm self-employed, but I can't get bank financing. Well, today we're going to talk about one way to step into real estate investing without considerable credit or borrowing power. That's the owner finance agreement. My name is Ben Scott with Grit Properties, agent for Western Maine here in Oklahoma City. Let's talk about it. Now, for years, we've been conditioned to the fact that to buy a home, you need traditional bank financing. But bank financing isn't for everyone. So today we're going to talk about one way to step into real estate investing without having to go through a bank. That's going directly to the seller. Now, many of the steps are the same as they would be with traditional bank financing. You establish terms, that'd be interest rate, contract price, etc. Then you establish a promissory note and a mortgage with that owner. The collateral of the loan is the house, and then you make monthly payments to the owner with interest. And just like a bank, a portion of that monthly payment goes to the principal. So why would a seller want to do an agreement like this? Or why would a buyer? Isn't it kind of risky on both sides without a bank acting as the middleman? First, let's go over the pros for the seller. Now, oftentimes a property owner in a situation like this has had a tenant in the house. So maybe now the house is vacant, or maybe they have a problem tenant. Maybe they inherited the house. There are literally dozens of reasons why somebody would want to sell a property that they're not living in. Either way, the first reason a seller might consider an owner finance. Number one, cash flow with no headaches or tax hit. The seller will still get their monthly payment every month, but they don't have to deal with a tenant. And they don't have to pay capital gains tax as they would if they sold the property in a traditional mode. If they were to sell that property outright and cash out, they'd be taxed on the cost basis of that home. And now the well of monthly payments has suddenly gone dry and you're hit with this big tax bill. This option allows the checks to keep coming with minimal taxes. Reason number two is no commissions. If a seller went through a traditional real estate brokerage, they'd have to pay up to 6% in real estate commissions. Through owner finance, the seller would have to pay little or no commission unless a realtor is involved somewhere in the process. Reason number three a seller could consider owner finance is large down payment up front with a high interest rate. In most seller finance agreements, the buyer agrees to pay a pretty hefty down payment up front with a higher than normal interest rate, usually at least one above prime, but it could be up to 10%. This is because the buyer doesn't want to or maybe can't qualify for bank finance. So for the seller, if your house is worth $100,000, you're getting 5, 6, maybe up to 10% return on your money. Reason number four a seller might consider owner finance is if the buyer defaults, the seller takes back the property. Believe it or not, this is a business model, kind of similar to the buy here, pay here auto finance that we see a lot of commercials for. You establish an owner finance agreement with a high risk buyer. You receive a large down payment with a high interest rate, almost with the expectation that this person will default. So when they stop making their payments, you foreclose on them with the mortgage you've already established. You take back the property, clean it up, and sell it to somebody else. So we've talked about the pros for the seller in an owner finance agreement, but how about the buyer? Is this a good deal for a buyer for owner finance? Reason number one, lower fees. We're all familiar with the closing costs that can add up when you're buying a house with traditional bank financing. That's loan origination fees, appraisal, flood cert, background check. These can be several $1,000s. But if you do an owner finance agreement with a seller, those closing costs, at least here in Oklahoma where I'm an agent, are minimal. So really the only fees you're paying in closing costs are to the title company. And you always want to close at a title company. But if you're, let's say, an FHA buyer, you're already putting 3.5% down. When you add all these closing costs, you really may not be out that much more cash than if you did an owner finance agreement with a large down payment. Reason number two a buyer could consider owner finance agreement is no ding on your credit. Now, you will establish a mortgage and a promissory note with the seller that will be filed with the county, but it's not part of anything reported to any credit bureau. So if you were to apply for another credit card or a different loan in the future, that owner finance agreement you have with that seller is not part of your credit profile. So the buyer would have an equitable interest in this property, but free up their buying power to do other things. Reason number three a buyer could consider owner finance agreement is quick close. Really, after all the title work is done, you can close on a seller finance or owner finance agreement in as little as 2 weeks. And reason number four a buyer could consider an owner finance agreement is there's still opportunity for cash flow. There is a situation, and I've done this myself, where you can get a tenant into a property in which you have an owner finance agreement and you can still make money on that tenant. If you can negotiate the right price and the right terms, you can put a tenant in that property and still make money every month. as you build equity into the property. Now, full disclosure, as a real estate investor, I have 3 owner finance agreements in place right now, all of which are cash flowing every month as I build equity into those properties. This option has allowed me to extend my portfolio without having to seek a line of credit to buy more property. Now, with any real estate dealing, there is risks involved. So, of course, check with an attorney or a real estate agent in your area and always close an owner finance agreement at a title company. Again, my name is Ben Scott with Grit Properties, agent for Weston, Maine here in Oklahoma City. If you have any comments or questions, please leave them below. I do look at those and would read those and would like to potentially do a future video on how to find an owner finance agreement. Today, we talked about the pros and cons of it for the buyer and the seller, but how do you find those deals? Maybe we can talk about that in a future video.